In the world of global finance, some of the biggest opportunities are whispered, not shouted. And right now, the whisper is all about a single politician in Japan.
That's right.
Her name is Takaichi, and she's on the verge of becoming the next prime minister. For traders from London to New York, her rise has kicked off what they're calling the Takaichi trade.
A very specific play.
It's a beautifully simple, almost brazenly profitable play. Borrow Japanese yen for practically zero interest and watch its value fall.
Basically, yeah. Bet on depreciation.
Takaichi is a true believer in the old gospel of Abenomics, basically. Rev up the money printers and flood the economy. She once called the idea of raising interest rates foolish, a statement that acted like a starting gun for the markets.
That word foolish really landed.
It did. The yen immediately began to tank, and it felt like the party was just getting started. But here's where the story gets interesting.
Right, there's always a catch.
While the government is signaling full steam ahead on cheap money, the head of Japan's central bank has been sending very different smoke signals. He's been talking about inflation, about tapping the brakes, and about the possibility of doing the one thing Takaichi called foolish.
The dreaded rate hike.
Exactly. So now we have this silent, high-stakes showdown. On one side, a new leader ready to open the floodgates. On the other, a central banker whose job is to stop the dam from breaking.
And the stakes are incredibly high.
This isn't just a political disagreement, it's a conflict that could trigger a global financial panic, and it's all about to come to a head.
A real potential flashpoint for the world economy.
And when we talk about a potential financial panic, we are talking about a systemic vulnerability woven into the fabric of the global economy. But before we dive into the macro mechanics, we have to start where all political movements begin, with the domestic hope and the risk aversion that defines the national mood in Japan right now.
You have to understand the context on the ground.
We've been analyzing the incoming Japanese prime minister's economic policies, this Takaichi trade. And while the charts are dizzying, the real story is always in how these huge decisions land at the kitchen table. I was thinking about someone like Kenji, a retired salaryman living in a quiet Tokyo suburb.
Typical experience for many.
For years, he's watched his modest savings generate almost zero interest. He remembers the boom times, but the decades of stagnation that followed, what they call the lost decades, left him and so many of his generation deeply risk-averse,
Absolutely. That fear is deeply ingrained after so long.
Under the banner of Abenomics, he saw a flicker of hope as the stock market, the Nikkei, finally came back to life. He cautiously invested a small portion of his retirement fund.
Took a bit of a chance, finally.
Right. Now, with the new prime minister promising to double down on these policies, there is a palpable buzz in the air. Kenji sees the reports. The yen is expected to weaken further, making Japanese exports ultra-competitive, and the stock market is projected to soar.
The narrative is very appealing domestically.
His financial advisor tells him this is a golden, possibly final opportunity for real growth. Every cautious instinct from his past screams, be careful. But the thought of his savings finally growing, of securing his retirement, and perhaps affording that postponed trip with his wife is a powerful lure.
That's the human element, isn't it? The hope versus the fear.
He spends his evenings looking at his small portfolio, toggling between the ingrained fear of the past and a new, unfamiliar sense of opportunity. For millions of Japanese citizens, the Takaichi trade isn't just a strategy for hedge funds. It's a deeply personal bet that their nation's economic engine can be restarted, even if it means devaluing their currency.
That narrative about Kenji is absolutely critical because it captures the immense domestic pressure Takaichi is responding to, the overriding necessity to drag Japan out of its long deflationary cycle and, lift stagnant growth.
Definitely.
Her unexpected ascent to the leadership of the Liberal Democratic Party, positioning her to potentially become Japan's first female prime minister, sent shockwaves precisely because of the rigidity and the ambition of her policy views.
She certainly didn't enter as the presumed winner. Before her victory, I remember analysts had priced in, a 60% probability for a different outcome, favoring Shinjiro Koizumi.
Yeah, the markets were leaning elsewhere. Takaichi, known for her deeply conservative, hawkish security stance, managed to secure the win largely through a highly coordinated effort that consolidated the conservative base of the LDP.
And she earned comparisons to the Iron Lady very quickly.
Those comparisons are earned, particularly in economics. Her core economic philosophy is a complete dedication to the legacy of Abenomics. This means she is a staunch reflationist, prioritizing large-scale quantitative easing and fiscal expansion.
So more QE, more government spending.
Exactly. And it's important that we define Abenomics fully beyond just money printing. It was originally based on those three arrows.
Yeah.
Aggressive monetary easing, that's the low rates flexible fiscal policy, so government spending, and structural reform. Takaichi seems intensely focused on the first two.
The monetary and the fiscal, the coordination arrow, as you said.
Exactly. What's crucial is her emphasis on coordinated fiscal and monetary policy. She believes the government and the central bank must work in tandem, almost seamlessly, prioritizing a specific type of economic boost. Demand pull inflation, driven crucially by higher, sustained wage growth.
Right, getting wages up is key for her.
That policy conviction is why her statement, calling interest rate hikes foolish, wasn't just rhetoric. It was a clear signal that the taps would remain open, setting the market direction immediately after her victory.
And the market reaction was explosive, wasn't it? Really crystallizing the Takaichi trade for global investors. Let's unpack the real-time mechanics. The immediate, sharp depreciation of the yen was the first sign.
It was a rapid repricing of Japan's future monetary policy path. The yen immediately plunged, hitting historic lows against the euro, but more relevantly, smashing past that psychologically important 150 JPY USD barrier.
150 is a big number.
It is. To give you the scale, the USD JPY pair, which measures how many yen you need to buy $1 US, meaning a rise, signifies yen weakness, increased by over 3.5% in just 3 days following her victory. It peaked at an intraday high of 153.22 per US dollar. This was the market instantly pricing in a prolonged era of ultra-low rates under her leadership.
Wow. And that currency collapse directly translated into the equity explosion we were talking about, rewarding domestic investors like Kenji. Tell us about the domestic stock market reaction.
Yeah, the stock market acted like it had been injected with adrenaline. The benchmark Nikkei 225 surged 4.8% almost immediately, hitting a new all-time high and pushing past the 48,000 psychological mark, even touching an intraday high of 48,100.
48,100, that's huge.
Huge. And the broader 2PX index also saw a significant surge of 3%. This wasn't just, speculative noise. This was institutional money betting heavily on continued stimulus hope, fueling a major bullish trend across Japanese industry.
And the gains weren't random, which is an important detail, right? We saw massive movement in specific sectors directly linked to her policies.
That's a key takeaway. The weak yen directly benefits Japanese exporters who suddenly gain massive pricing power overseas. So sectors like AI and semiconductors saw sharp gains. But we also saw huge surges in defense stocks.
The defense angle too.
Exactly. Mitsubishi Heavy Industries, for instance, rose over 11%, and Japan Steelworks surged more than 15%. This signals that the market is factoring in not just the Abenomics policies, but also Takaichi's hawkish security stance, expecting increased government defense spending and technological investment, creating kind of dual boost for those specific firms.
Okay, so currency down, stocks up, particularly exporters and defense. Now, let's turn to the bond market, because this is where the underlying tension in the financial system truly revealed itself. We saw the yield curve steepen sharply. For listeners who might not be familiar with bond mechanics, what does a steepening yield curve actually mean in this specific context?
Okay, so the yield curve plots the interest rates of bonds over different maturities, say 3 months versus 10 years. When it steepens, it means the gap between short-term rates and long-term rates widens dramatically.
Okay.
Takaichi's victory suggested the Bank of Japan would delay raising its short-term policy rate, right? So those short-term bond yields fell, reflecting the expectation of cheap money sticking around longer.
Makes sense. Keep the near-term cheap.
But, and this is the crucial part, the yield on the long end, the 10-year Japanese government bond, or JGB, soared to a 34-year high of 3.29%.
34 years. Wow.
Yeah, this is the steepening. Low short-term rates, but spiking long-term rates. This signals a fundamental long-term concern among investors. While they believe the government will continue easing money now, they are worried about the future inflationary consequences of that massive spending and, frankly, the fiscal sustainability of Japan's huge debt load.
So they're demanding more return for the long-term risk.
Precisely. They're demanding a much higher rate of return to hold that long-term Japanese debt, which points to serious skepticism about the long-term effectiveness of, let's call it, Abenomics Mark II.
That steepening curve tells us that the bond market is worried about the price tag down the line, but the most immediate measurable impact was the complete shift in central bank expectation. The market's probability of a rate hike in October just evaporated, didn't it?
It was a dramatic repricing. Before her victory, some reports pegged the probability of an imminent October rate hike by the BOJ, which would have been the first since that previous small surprise in July, as high as 60% or even 68%.
That high. Okay.
That probability immediately plummeted following Takaichi's success, dropping to as low as 24% overnight. The market consensus instantly shifted to pricing in a hike to 0.75% being delayed until December, or perhaps even later.
So the market just said, okay, no hike soon.
Exactly. That single massive change in expectation is the fuel that powered the initial wave of the Takaichi trade. It validated the assumption of prolonged, dirt-cheap yen funding for global investors.
And that cheap funding is the foundation of the second, far more dangerous part of this story. While domestic investors like Kenji are, enjoying a stock market surge, we have to acknowledge that this trade does not stop at Japan's borders. A weak yen creates immense pressure globally, and especially for their immediate neighbors.
That's the spillover effect. It's significant.
When we talk about the economic boost a weak yen provides to Japan, we are talking about a direct transfer of pressure onto competing export-oriented economies. I was looking into the situation in the manufacturing heartlands of South Korea, and it paints a stark picture. Consider Park, a mid-level manager at a key auto parts manufacturer in Ulsan, South Korea.
Right, a direct competitor nation.
His company supplies major Korean car brands and competes daily with precision Japanese rivals. For years, they've managed to maintain a competitive edge through efficiency and quality.
Hard-won gains.
But now, with every tick downward in the Japanese yen, that fight gets harder and potentially impossible. Park's spreadsheets look grim. A Japanese competitor can suddenly offer an identically high-quality part for 10% to 15% less, not because they've innovated or streamlined their process, but purely because of the currency exchange rate.
It's a huge artificial cost advantage handed to the Japanese firms.
Last week, Park was forced to delay planned equipment upgrades that were necessary to stay ahead of the technology curve. This week, the conversation turned to potential layoffs, starting with temporary workers. His team's anxiety is palpable.
You can imagine. Their jobs are on the line.
Their livelihoods are threatened not by internal mismanagement, but by a coordinated monetary and fiscal policy decision made in a government building hundreds of miles away in Tokyo. This dynamic, where one nation's domestic revival plan becomes its neighbor's economic challenge, highlights the intense, fierce interdependence of the Asian economy. It's the ordinary workers in neighboring nations who bear the brunt of this rivalry.
Park's reality is the direct, painful regional consequence of the Takaichi trade. And the engine that generates this global pressure is the mechanism known as the yen carry trade, or YCT.
Okay, let's clearly define the yen carry trade again, but this time let's really emphasize why it is the core source of global systemic risk we keep mentioning.
Okay, the YCT is fundamentally a sophisticated form of arbitrage, relying heavily on leverage. Traders exploit the interest rate differential. They borrow yen at next to nothing. I mean, Japan's rates have been effectively below 0.1% for 15 years.
15 years, yes.
And immediately convert that cheap funding into higher-yielding currencies, typically the U.S. dollar, and invest in assets globally. We're talking about U.S. stocks, corporate bonds, real estate, and especially high-yield emerging market debt. The profit comes from the vast difference in interest rates, the spread, plus any gains on the assets they buy.
So borrow low, invest high. Seems simple enough on the surface.
On the surface, yes. But the leverage amplifies everything.
And the Takaichi effect isn't just a small factor here. It's the ultimate validation for this trade, isn't it? Like pouring gasoline on the fire.
It's the green light. Absolutely. Takaichi's policy commitment reinforces the market's core assumption that yen funding will remain the cheapest in the world for the longest duration possible. This virtually guarantees that the carry trade remains attractive, amplifying global liquidity flows.
So more borrowing, more investing elsewhere.
Exactly. It means Japan is essentially exporting monetary stimulus to the entire world, contributing significantly to asset inflation in places like Wall Street and Sydney.
And this brings us back directly to the regional competitive dynamics affecting managers like Park in Korea. This policy is a double-edged sword for the region, isn't it?
It absolutely is. A sustained weak yen under Takaichi is devastating for nations like South Korea, Singapore, and Taiwan, whose massive manufacturers compete directly with Japanese firms in sectors like autos, machinery, and technology.
They're head-to-head competitors.
Totally. When the yen weakens significantly, as Park experienced, it creates an instantaneous competitive disadvantage, often a 10% to 15% cost differential, purely due to the exchange rate. This means Korean firms must either cut prices drastically or lose market share, regardless of how efficient they are.
That's brutal.
It is. Following Takaichi's victory and the rapid yen depreciation, the Korean won-USD exchange rate surged past 1424 KR/KV USD. This reflected the market realizing that the yen's continued weakness would force competing Asian currencies downward, putting extreme, unsustainable pressure on their vital export sectors.
Okay, so this high level of leverage and global interconnectedness brings us to the danger point. We don't have to just imagine what a sudden break looks like, because we have a very clear precedent from just a few months ago. The market unwind of August 2024. What exactly was the perfect storm that triggered that catastrophic correction?
Well, the trigger was basically a collision of two unexpected events that shattered the core stability assumptions of the yen carry trade. First, back in July 2024, the Bank of Japan delivered a surprise micro-hike, pushing their policy rate just above 0.25%.
Just a tiny hike, but unexpected.
Tiny, but it broke the spell. It made the cost of borrowing yen slightly more expensive, and more importantly, raised fears of more hikes to come. Second, almost immediately following that, disappointing U.S. labor market data in early August fueled fears of a sudden U.S. recession, which is bad for high-yield assets globally.
So the assets they bought started looking risky too.
Exactly. Suddenly, the profit assumptions of the YCT cheap funding and rising asset prices were completely undermined. Both sides of the equation went sour.
Walk us through the mechanism of the unwind, then. This is where the sheer scale and leverage of the YCT become truly terrifying.
Right. When the yen strengthens unexpectedly, as it did in response to that BOJ move, leveraged traders immediately start accruing losses on their yen loans. They face urgent margin calls from their brokers, forcing a sudden, rapid deleveraging spiral.
Margin calls the dreaded phone call.
Exactly. To cover these losses and repay their suddenly more expensive yen debt, these highly leveraged investors are forced to liquidate their high-yielding foreign assets. The U.S. stocks, bonds, and emerging market debt they bought with the borrowed yen. It's a fire sale. They sell dollars, euros, whatever, buy yen, and the yen appreciates even further, accelerating the selling pressure. It feeds on itself.
A vicious cycle. And the resulting market shockwaves were felt globally. How severe was the fallout in August?
It was severe enough to remind us of past systemic crises. The S&P 500, the benchmark for global markets, plunged 325 points in just 5 trading days. That included losses of 1.8% and a brutal 3.0% loss on August 2nd and 5th, respectively.
3% in a day is a big move for the S&P.
A very big move. But the epicenter, the Japanese 2-Pi-X index, suffered a stunning 12% loss in a single trading day on August 5th.
12% out.
Yeah, devastating. Furthermore, the VIX, the volatility index, often called the market's fear gauge, spiked to levels not seen since the height of the COVID-19 crisis. This spike signals intense, rapid liquidation driven by pure panic.
And the global currency impact confirmed that this was a massive forced repatriation of funds back into yen, right?
Absolutely. As leveraged traders sold off their investments and bought yen to cover their loans, the currencies of the high-yield targets they were invested in suffered sharp depreciation. The Mexican peso, Brazilian real, South African rand, they were all hammered.
So it hit emerging markets hard too.
Definitely. This episode demonstrated one undeniable fact. The yen carry trade connects Japanese interest rates directly to global asset prices and currency stability everywhere. It's not contained.
So if that August crisis was so severe, what's the scale of risk we are dealing with today under the newly revitalized Takaichi trade? How big is this ticking time bomb?
We're dealing with a multi-trillion-dollar exposure, realistically. While the fast money, speculative shorts in futures markets largely unwound during the August event, having peaked around $15 billion, the deep structural exposure remains enormous.
So the tourists left, but the residents are still there?
That's a good way to put it. We need to look at two main figures. First, yen-denominated loans to non-banks outside Japan, a key metric for the carry trade funding structure, stood at approximately $40 trillion, which is about $250 billion by early 2024. That's the sticky structured debt underpinning the trade.
Okay, $250 billion in direct loans. That's significant institutional leverage.
But the truly staggering figure relates to Japanese investors themselves. When we look at their unhedged foreign equity holdings money invested abroad that is extremely vulnerable if the yen suddenly strengthens, that figure stands at roughly $150 trillion, or about $1 trillion.
$1 trillion, just in unhedged equities held by Japanese investors.
Roughly, yes. The combined scale of this exposure means that any future unexpected BOJ policy shift could trigger liquidations orders of magnitude greater than what we witnessed during that flash correction in August.
That's quite sobering.
It is. This is why financial analysts often connect the underlying risks of the YCT to the systemic dangers seen in the collapse of leveraged hedge funds like LTCM back in 1998, or the sudden seizure of credit markets leading into the 2007 subprime crisis. The core mechanism is the same. Massive leverage dependent on ultra-cheap funding and market stability.
And that takes us directly to the heart of the matter, the central bank. The Bank of Japan is now standing directly in the path of the new prime minister's political and economic ambitions, knowing that their next move could either sustain the $1 trillion carry trade or, well, collapse it.
They're in an incredibly difficult position.
Let's look at the institutional tension and the incredible pressure being felt right now. Imagine a young woman, let's call her Akari, working in the risk management department of a major international investment bank in London. She's responsible for modeling the exposure of her bank's various trading desks to this very conflict, the Takaichi trade versus the central bank's mandate.
A crucial job right now.
Her daily focus is a series of complex simulations based on one critical question. What is the absolute breaking point for the Bank of Japan? The policy of near-zero rates has woven the yen carry trade into global liquidity for years. But now, with inflation ticking up in Japan, the noise and the risk is growing exponentially.
The models must be flashing red.
Akari's models show that even a slight, unanticipated rate hike could trigger a catastrophic global unwinding. She sees the chain reaction. The yen surges, global investors rush to repay loans, leverage assets are liquidated, and markets from New York to Sydney plummet.
The dominoes falling, essentially.
She is living in a world of probabilities, knowing that behind the numbers are the real-world consequences, a potential systemic shock. Her job is a constant, stark reminder of how interconnected and fragile our financial system is. The decisions made by a handful of officials in Tokyo no longer just affect Japan. They are a critical variable for the entire world economy.
Akari's models are focused entirely on the central policy conflict. The BOJ is caught between the new prime minister's intense political pressure to maintain easing and the central bank's core legal mandate, which is to achieve price stability and combat inflation. It's a direct clash.
And the central bank cannot just ignore the inflation reality check, despite Takaichi's political platform, can they? What is the BOJ actually staring at in terms of prices right now?
No, they can't ignore it. Takaichi is pushing for easing to generate demand-pull inflation, but prices are already moving too high for comfort. Inflation in Japan is running stubbornly above the central bank's 2% target, hovering in the 2.4% to 3% range.
Still above target, then?
Consistently above target. And BOJ Governor Ueda has been incredibly clear in his statements, despite the political noise from the LDP. He recently indicated that the bank will continue to raise policy rates, assuming price increases materialize as expected, noting critically that actual interest rates are extremely low.
That sounds like a direct pushback against Takaichi.
It is. That statement is a direct defiance of the Takaichi Doctrine. He's signaling that, based on his mandate, the current monetary policy is dangerously loose given the prevailing economic reality. He's laying the groundwork.
So, if the politics are pushing one way, what are the precise economic indicators the BOJ is monitoring that will ultimately force their hand to hike, regardless of the prime minister's wishes? What makes them pull the trigger?
Well, they are focused primarily on three concrete sustainable factors. First and foremost is sustained wage growth. Takaichi wants demand-pull inflation driven by wages, but the BOJ needs to see proof that it's really embedded, not just a temporary blip.
You need to see it stick.
Exactly. The median forecast is expecting wage growth around 4.8% next year. If wages accelerate consistently, that's their clearest justification for tightening policy. Second, they are watching trade data, which reflects the international strength of Japanese manufacturers and export pricing power.
Okay, wages and trade.
And third, they rely heavily on the Tankan survey. That's a big quarterly survey assessing business sentiment across the country, particularly how companies feel about future investment, inflation, and crucially, the impact of global factors like U.S. tariffs and exchange rate moves. If these indicators remain resilient, showing the economy can handle higher rates, a December hike becomes highly likely, even if the markets had priced out the October move after Takaichi's win.
So the data could still force their hand by year-end. And if the BOJ delays tightening purely for political reasons, bowing to Takaichi, what's the long-term risk to their institutional standing? Does that matter?
Oh, it matters immensely. The risk is profound. A loss of credibility. Analysts suggest that prolonged dovishness, that is, Keeping rates artificially low, while inflation is clearly persisting above target, will severely undermine the BOJ's independence in the eyes of the market and the public.
So people stop believing they'll actually fight inflation.
Precisely. If the public starts believing the central bank is merely a tool of the prime minister's fiscal policy, it risks embedding higher long-term inflationary expectations in the economy. This would make the eventual tightening far more painful and disruptive, requiring much sharper hikes later on to re-anchor price stability. The BOJ must protect its independence to manage expectations effectively. It's core to their function.
Okay, let's turn back to the immediate flashpoints, the points on the chart that risk managers like Akari are modeling where the system truly breaks. Where is the yen right now, and what exchange rate level signals an almost certain intervention from the Ministry of Finance?
Well, the most immediate dangerous flashpoint is the USD-JPY exchange rate approaching the critical 155 JPY-USD resistance level. This level is highly significant because it has historically prompted Japan's finance ministry to intervene directly in the market, often through massive yen buying operations, or at the very least issue strong, coordinated verbal warnings to try and stem rapid yen depreciation.
So 155 is the line in the sand.
It seems to be, historically speaking. As the currency pushed past 153 following the Takaichi victory, the pressure on the finance ministry to preemptively act, maybe even before 155 is breached, becomes immense. They don't want a disorderly collapse.
But the truly systemic risk is not just about intervention to slow the fall. It's the fundamental conflict between Japan's domestic policy and global financial stability. We're talking about the breaking point, the YCT unwinding that forced the August correction, but potentially on a much larger scale.
Exactly. The foundational risk is that a sudden, unexpected BOJ hike, even a minor move, or perhaps even a failure to clearly signal continued easing when the market expects it, could instantly trigger a global investor panic.
The rug pull moment.
Yes, they rush to repay their cheap yen loans, forcing asset liquidations across global markets, triggering a systemic crisis. This risk is why financial historians draw those parallels to 1998 with LTCM and 2007 with the subprime lead-up. We're dealing with an interconnected system where leverage is concentrated, and the funding source, the yen, is controlled by a central bank now operating under severe political duress.
So the BOJ is on this incredible high wire. They have to fight domestic inflation and uphold their credibility, all while ensuring they don't move so abruptly that they detonate the global financial system built on their cheap money.
Their decisions are completely interdependent with global outcomes. We know this because of remarks from officials like Deputy Governor Uchida. He suggested in the past that the BOJ is willing to adjust policy not just based on domestic data, but to actively avoid rapid yen appreciation that could endanger their fragile domestic inflation goal.
So they worry about the yen strengthening too much too quickly as well.
Absolutely. That is the ultimate tightrope walk. The central bank must constantly balance domestic policy objectives, getting inflation sustainably, to target against the very real systemic risks of global financial instability caused by the massive, concentrated unwinding of the yen carry trade if they move too fast or surprise the markets. They have to manage the global market's perception of their decisions as much as the domestic economy itself.
It's a fascinating and frankly quite frightening balancing act.
So we started this deep dive with the Takaichi trade, this politically driven bet on stimulus and a weak currency designed to restart Japan's economy and reward domestic investors like Kenji.
Right, the domestic hope.
We quickly saw how this strategy creates sharp economic pain for regional competitors, putting managers like Park in South Korea under intense pressure due to the instantaneous cost advantage gifted to their Japanese rivals.
The regional pain point.
Finally, we examined the Bank of Japan, caught in the middle. Their complex, high-stakes decisions, modeled rigorously by risk managers like Akari in London, hold the ultimate power to either sustain the Takaichi trade's momentum or trigger a violent global unwinding of leverage.
The core tension is perfectly clear, and it feels almost unprecedented in recent history. Japan's economic future is tied to expansionary policies that rely on the yen remaining cheap. But the global financial system has become entirely predicated on the stability and availability of that same cheap yen funding. That fundamental policy divergence makes Japan's next move the highest stakes tightrope walk in global finance today.
For decades, ultra-low interest rates in Japan have woven the yen carry trade into the very fabric of global finance, providing cheap funding that underpins assets from New York to Sydney.
But
This means that the success or failure of Japan's new prime minister's domestic economic revival plan has ceased to be a local story. It is now a definitive global systemic risk, making the silent showdown between Tokyo's government and its central bank a critical flashpoint for the world economy.